Hey everyone, I wanted to bring you my top 24 stocks to buy right now in June and hold for the rest of 2024 and beyond. I've been giving you an update to my list of top stocks to buy every month this year, and I'll continue that trend throughout 2024. So without further ado, let's take a look at this list of excellent stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first stock on my list is the Walt Disney Company, trading at a forward price to earnings of 19. The Walt Disney Company's theme park segment continues to thrive, generating record levels of profitability. Meanwhile, the streaming segment is expected to reach profitability in the next quarter or two and then expand beyond that point. I like each of the industries it operates in, and the company is selling at a relatively cheap valuation at a forward PE of 19. Alphabet is trading at a forward PE of 20, and it's second on my list of top stocks to buy here. But overall, it is my favorite stock to buy, actually. This list is not in a ranking order, it's just a list of my top stocks to buy. But Alphabet is my actual top number one stock to buy right now. It's trading at a forward PE of 20.36, a relatively cheap valuation for the most dominant company in the advertising industry. Nvidia, what else do I need to say about Nvidia? The company is absolutely thriving on the back of the rising effectiveness of artificial intelligence. And despite the fact that the stock price is up over 100% already in 2024, it's still trading at a relatively cheap valuation of a forward PE of 31. Visa, trading at a forward price to earnings of 24, is actually my favorite dividend stock to buy this year, and it has been on that list and on that ranking all year long. I love Visa's business model, generates the best profit margin of any business I follow, and it's got a strong competitive advantage, trading at a relatively cheap 24.34 forward PE. PayPal trades at a forward PE of 13.82. Again, I think this stock is cheap given its profit margin, its cash flow, and its return to growth in a couple of key metrics I was looking for it to do, which is its monthly active user count, and management recently upgraded its earnings per share outlook for 2024. Fiverr International trading at a very cheap valuation, a forward PE of 10. The company is an Israeli-based company, and the war in the region is bringing down valuation. Also, Fiverr's revenue growth has slowed down considerably, but I still like the gig economy platform longer term. Netflix trading at a forward PE of 29. The streaming content industry, like I mentioned for Disney, is one of my favorite industries right now. Competition is easing significantly industry-wide. If you have streaming services, what have you noticed lately? They're all raising prices, cutting content costs, restricting password sharing, all of which is good news for investors, not very good news for customers, but good news for investors, and that's bringing up profitability for all of the participants in that industry. Alibaba trading at a forward price to earnings of 8.469, a very cheap valuation for this company. Again, another company where revenue growth has slowed down, but management is re-accelerating growth, making investments in artificial intelligence. And if this company was a US-based business, it would be trading at 2 or 3 times the valuation it's currently trading at. The geopolitical issues are bringing down valuation for Alibaba stock. Uber trading at a forward PE of 20. Uber's made great strides since the CEO change, since Dara Khosrowshahi, I hope I said the name right, stepped into the CEO role, really turned things around in terms of the cash flow from operations and the profitability of the business, really focused on those metrics and performance, and I've been pleased with what I've seen from Uber, trading at a relatively cheap forward PE of 20. It's also one of my favorite stocks right now. Amazon, at a forward PE of 30.88, is increasing revenue at roughly 10% per quarter year over year, but profits are absolutely soaring because the company's reducing capital and expenditures because it invested in the infrastructure in 2020 and 2021, and it's now finding efficiencies, finding ways to be more effective, and that's all leading to increasing profitability. I really like what I see from Amazon. Target, trading at a forward PE of 14.94. Target made a great strategic move in turning its stores into an advantage with the buy online and pick up in the Target parking lot. Customers have absolutely loved that. That's led to billions of dollars of incremental sales for Target. And going forward, I think consumers will continue to pay for that convenience. As we've seen worldwide, consumers are willing to pay for convenience, and Target's just made a big step forward for the company in terms of convenience. The next batch on my list begins with eBay, which is trading at a cheap forward PE of 10.81. eBay runs an asset-light business model, bringing buyers and sellers together and taking a fee for each transaction. This industry as well is decreasing competition by raising the fees they charge merchants, and industry-wide, everyone is benefiting from higher profit margins. Zoom Video Communications at a forward PE of 12. Zoom attracted billions of customers or hundreds of millions of customers during the pandemic, and it's maintained its revenue level even though growth rate has slowed down and profit margin has decreased. It's maintained its revenue level and is growing from that massive surge it experienced in the early stages of the pandemic. Chewy, trading at a forward PE of 20. The management team told investors in late 2023 that this year was going to be a challenging one and really drove down expectations. That brought the stock price down to really cheap valuations, and Chewy just reported results for the first quarter of 2024 that were a lot better than expected, and the stock price jumped by 30%. I still like Chewy stock even at a forward PE of 20. Meta Platforms, the most dominant social media company in the world, trading at a forward PE of 20. The company generates very good profit margins, revenue growth is accelerating, and billions of people check in one of Meta's apps daily. AMD recently launched its MI300X graphic processing unit that aims to take a share of the massive artificial intelligence market. It's not going to catch up to NVIDIA, but even if it takes a smaller slice of that massive pie, it could lead to excellent gains for shareholders. Snap, meanwhile, not as great as Meta Platforms in terms of social media dominance, but it's still doing a great job with its hundreds of millions of daily active users, and it made sufficient cost-cutting efforts to start boosting cash flow from operations. Coca-Cola, trading at a forward PE of 20.91. It's benefiting as more people are spending more time dining away from home, entertaining themselves away from home. Coca-Cola has a stronger market share in away from home channels, places like restaurants and theme parks and movie theaters. Think about it, when you go to McDonald's, that's an exclusive relationship with Coca-Cola. And so because people have been eating out more often, Coca-Cola is benefiting from that trend. I expect that will continue for the rest of 2024. Home Depot, the most dominant home improvement company in the world, trades at a forward PE of 20 because people have temporarily neglected their homes, right? Remember in 2020 and 2021, home improvement projects were extremely popular. And now, like I said, people are spending more time and money away from home. That's causing a dip in Home Depot's valuation, and I see that as a buying opportunity. People will always need to spend money on their homes. Things break, things need to get fixed. Home Depot is the leading player in that industry. Six Flags trades at a cheap forward PE of 12, and that away from home trend is beneficial to Six Flags Entertainment. People want to do things outside of the house, and theme parks have been one of the more popular pastimes here ever since the economic reopening gained momentum. Salesforce recently reported disappointing quarterly earnings results that sent the stock price down, but I still reviewed those results and I reiterated my recommendation. I still like Salesforce at current valuations. Finally, in this batch, Nike trades at a forward PE of 24. Nike too has had a difficult start to 2024. It announced cost-cutting and restructuring efforts. You have rarely been able to buy Nike stock as cheaply as you're able to buy it today because of those recent difficulties. Now, those stocks I mentioned have been on my list of top stocks to buy all year. The newer additions to my portfolio were Micron Technology and UiPath. Micron trades at a forward PE of 14. UiPath recently reported disappointing results and a leadership change that sent the stock price lower. I reiterated my recommendation. I still think UiPath is a top stock to buy right now. So now that I've given you my top 24 stocks to buy, let's take a look at how they've performed. All right, so here's the first batch of performance. NVIDIA, of course, being the best performer at 121%. Now, I'm not going to go through each one of these individually. I just want to list the performance here, and then I'm going to go to an Excel sheet where I'm going to calculate my return on investment for this portfolio and compare it to the S&P 500. But I just want to show it in case you want to pause and go back and double check my numbers here. And in the second batch of numbers, not as good as results as the first batch, but still you have some solid gainers here, especially with Meta Platforms being up 32%. And the worst performer in this batch is Zoom Video, down 14.7%. Micron Technology is up 31% since I recommended it in March. That was a good pickup to my portfolio when I added it. However, UiPath was a terrible pickup to the portfolio. I added UiPath less than a month ago in May, and it's down 36% since making that recommendation. The bulk of the drop coming after the company announced disappointing earnings, downgrading the profit outlook and replacing the CEO because the previous CEO resigned after just a few months. So this has not been a good addition so far. Now, looking at the broader market, the S&P 500 ETF, the SPY is up 11.23% year to date, but that's on a market weighted basis. The heavy big cap, mega cap tech stocks play a larger role in the S&P 500 ETF. The equal weight ETF is a more fair comparison to my portfolio, the way I'm calculating my portfolio, because I'm giving each one of my stocks in my portfolio an equal weight. I'm not overweighting NVIDIA's performance because it's a large cap tech stock and it's performed, over 100%. If I was to, market weight my performance would be much, much better because it would grant a greater percentage of return for my pick of NVIDIA. So now let's go to my performance. So here are the list of performers. Here I've calculated all of the returns in this list, and my portfolio return so far year to date is 9.95%. Now, if you compare with the S&P 500 ETF, which again is market weighted, my portfolio, I haven't calculated market weight, I calculated equal weight, I would be underperforming slightly. But if you count against the equal weight, that's brought in 5.47%, and my equal weight portfolio return has brought in 9.95%. So I've significantly outperformed the equal weight ETF. But I often caution at the end of these videos, even though my performance has exceeded that of the S&P 500 equal weight ETF, I've been cautioning investors not to expect this kind of outperformance to continue. It's been nice that I've been outperforming the market so far year to date in 2024, but it's just 1 year. It's not even been 1 year. Sure, I also outperformed in 2023, but even if you include my outperformance in 2023 and 2024, it hasn't even been 2 years of outperformance. So it's not like you can make a conclusion and say, okay, Parkev's an outperformer. His picks are just always going to outperform the market. I should just always go with his picks. Don't follow that conclusion. Don't come to that conclusion. There hasn't been enough evidence to come to that conclusion. It's just been a positive outcome for now. The market factors have worked in my favor so far, but that's not necessarily going to continue. I just wanted to provide a cautionary moment there for investors. It has been nice though. Hopefully it continues, but be cautious. it's not expected to go on forever. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.